Testing 1, 2, 3. Can you guys hear me? Can you guys hear me? Let me know. Okay. All right. Okay. I beg your pardon. I'm going to leave the camera off. Can you guys see the screen? Morning market review, Monday, 19th of December. My name is Russell, Senior Market Specialist at FXCM. Okay, brilliant. Much better. I'm going to leave the camera off. Let's just bring up the high risk investment warning. I'll keep this on screen for a few moments. And our market commentaries disclaimer. And our references: Market Scope, Trading View, FXCM, calendar, and Bloomberg. We'll just have a quick look at the calendar. There's actually no real red items for today. Perhaps we want to just keep an eye on the housing market index. A little later, that's 5 p.m. ZA, 3 p.m. UK. The IFO business climate, that's something I think we should keep an eye on. Okay, out of Germany. All right, I'm just going to bring up this chart over here. This is the DAX. We did take a look at this last week. I just wanted to give a sort of update to what we saw. But before we do that, I'll just go through the Bloomberg email. So the first is China's COVID. It's more than a month after China started seeing an exponential surge in COVID cases. The country has only reported 2 virus deaths, defying the experience of other more vaccinated and better resourced places as they reopened, and fueling suspicion that the true scale of fatalities is actually being hidden. So that's the first headline. Second headline, European Union member states will on Monday discuss a gas price cap that's almost 1/3 lower than an original proposed, as they attempt to break a deadlock over the controversial proposal to contain the impact of a historic energy crisis. The Czech government, which holds the EU's rotating presidency, suggested lowering the ceiling to 188 euros per megawatt hour, compared with the 275 euro proposed by the European Commission last month. Next headline, Elon Musk under fire for recent policy changes at Twitter, is asking users to vote on whether he should step down as head of the social media site. The billionaire owner of Twitter and chief executive officer of Tesla will abide by the results of the poll, he pledged in a tweet Sunday. I did take a look at the results. At the moment, it's over 50% that he should step down. The poll's still open, so we'll see how it ends. $1 trillion energy bills. This headline reads, Europe got hit by roughly $1 trillion from surging energy costs in the fallout of Russia's war in Ukraine, and the deepest crisis in decades is only getting started. After this winter, the region will have to refill gas reserves with little to no deliveries from Russia, intensifying competition for tankers of the fuel. Even with more facilities to import liquefied natural gas coming online, the market is expected to remain tight until 2026. When additional production capacity from the US to Qatar becomes available. This means no respite from high prices. Coming up today, European equity futures are looking a little brighter than stocks in Asia that saw more declines as investors digested last week's hawkish commentary from the European Central Bank and its US and UK counterparts. UK wasn't actually that hawkish. Just wanted to put that out there. Germany's IFO business climate is expected. We saw that. All right. Let's take a look at the chart. And what we have here is the daily chart of the DAX. Last week, what we did was okay, Shadrach, thanks for telling me. Yeah, noted. You can see that there was a squeeze here in the Bollingers, and then we put in this Bollinger width and said, look, there's going to be some sort of expansion in volatility. The problem is that there is no real directional bias with a squeeze. Well, there might be a bias, but we don't know sort of really which way the expansion of volatility will go. When I say there's a bias, I suppose we can take a look at it in terms of zones. If it was in zone 3, then it would be a bearish. Nevertheless, the Bollinger width has crossed back above that horizontal, this black horizontal, and look how the expansion in volatility is taking place here, and it's certainly heading in the bearish direction. Now, I want to take a look at this in a little bit more detail. Hey, Katie, yeah, got you. Okay, Katie just asking for Nasdaq and oil as well. All right, let's just go through to the main layout here, and we're going to go back to DAX. And I just want to take a look at this in a longer term, broader view. I want to take a look at this from the weekly. And I think it gets really interesting when we take a look at it from the weekly. So is this pullback really, is it really sort of a new bear market? And whilst the possibility, of course, is there, this pullback is actually just at the moment a correction in a broader impulse move up. I mean, it's painful, and you can see that last week's candle is a very odd looking candle. It's it opened, shot up to the high. The bears ripped control away from the bulls at the high, and they've pushed price right down. That was because of the central bank activity last week. We had a super hawkish Fed, we had a super hawkish ECB, and it's really just pushed the index down. Now this is now we're going to have to try and sort of make some assumptions here. So is this a bear market? The answer to that is no, it's not. How will it become a bear market? Well, it would have to have a lower peak, and it would have to move into a lower trough. And that's sort of the definition of a downtrend, lower peak followed by lower trough. We don't have that. In fact, we've got something that's looking not too bad on a technical basis, but I'm going to latch on to until proven otherwise, because we don't want to predict, we don't want to make forecasts. But I do want to say that this is something that we spoke about. We said that there needs to be some sort of correction. We put in HT question mark. I've just pulled out the question mark, okay? And well, this sets up a nice platform for a potential higher peak. I don't know if we get that. We may get the lower peak followed by the low trough. And the lower peak followed by the low trough, I think, would follow the narrative that's been thrown around in the media at the moment. And we want to just try and be sort of as objective as we can about this. I'm not sure that this is necessarily a bad thing. I would suggest this was needed, this correction was needed. And again, I'm just going to say this, it's not something that should surprise us. We spoke about it. Okay, so this correction here seems very much in line with the normal peaks and troughs of a trend. Now, this is where the assumptions come in. The assumptions say, wait a second, Russ, how can you say that with such hawkish central banks? And this is where it gets quite tricky, the analysis. So let's go back to TradingView and see if we can put things together in a sensible manner. And I think the way to start here is we're going to look at the US side of things as a proxy for just general credit conditions. not necessarily credit conditions, I beg your pardon, treasury conditions. So let's get rid of that. Let's get rid of the Bollinger. And what we're going to do here is we're going to look at the yield curve. So we're going to put in the US 10 year. This is also something that we've looked at, but I think it makes a lot of sense just to look at this again, because when we do look at it from a monthly point of view, I think things start making a bit more sense in why we could potentially still be in the early stages of a bull market, not a bear market, early stages of potentially of a bull market. Now, again, I'm going to have to tag on subject to correction here, because making forecasts, these type of predictions, won't serve us if we're wrong, right? So we've got to be quite careful here. But what we can see is that the yield curve is still very much inverted. Now, it's got to the point where it's such a steep inversion that I think that we can go ahead and say, look, we're probably heading to a recession if we're not in recession already. If you take a look at some of the economic data that came out, the retail sales were very poor. The manufacturing activity was very poor. What's not poor, what's lagging, is the jobs, the jobs data. Jobs data is quite robust at the moment, but the actual economic data, ex-labor data, is really starting to contract. So the idea here is this is a very severe inversion. What is it? It's the 10-year minus the 2-year. Okay, so let's just go ahead and bring up Microsoft Paint and just understand what's happening here. Okay, so we've got the yield here, so we're just going to call this interest. Okay, interest, and here we're going to say term to maturity. Okay, term to maturity, and what we have here is the 2s and the 10s. And what we effectively have is a curve like this. In other words, so just to make sure everybody on this page, what we're doing here, we're looking at the difference between the 2s and the 10s, right? The difference between the, sorry, the difference between the 10s and the 2s, yeah. In other words, 10 minus 2, well, 10 minus 2, okay, well, 10's a lower interest rate than 2. That's why we've got the inversion. That's why we've got this negative gradient. Now, it can't stay inverted forever, okay, because of the business cycle. The business cycle tends to go through expansions and declines, expands and declines, expands and declines. That's what the, so kind of in a declining type of part of the cycle now, but declines turn into expansions. And one of the ways they turn into expansions is through actual adjustments in the labor market, believe it or not. But effectively what happens is when there is a change in the, then we get a normal yield curve. Okay, so it moves from inversion back to steeper. Now, this is where we are now. This is where we are now. Now, what's the quickest way for this to become a normal curve? Well, the quickest way will be for the 2 years to come down. And then we've got a normal positive slope again. And slowly the longer term starts moving up as well. So, but the primary adjustment takes place on the 2s. Okay. Well, that's monetary policy. Okay. So what I'm saying is that although the central banks have been exceptionally hawkish, okay, although they've been exceptionally hawkish, the market's not buying it. The market's saying, well, we've got a severely inverted yield curve. The Fed is now probably going to have to pivot. When it does pivot, it's going to have to pivot quickly. And that makes for very, very interesting markets. Now, let's go back to this year. Peak, higher trough, high peak. Markets are forward-looking. Okay, markets are forward-looking. So if we think that there is going to be a recession, okay, so we've priced that in. Okay, where did we price that in? We probably priced that in over here. Okay, now we start looking for, because now we're into the recession. The economic data is starting to pinch now. Now we're starting to look for the time when there has to be a Fed pivot. Well, markets are forward-looking by about 9 months. Okay, financial markets, they're forward-looking. The studies that I've read between roughly between sort of 6 and 9 months, but conventional thinking is about 9 months. So if they're 9 months, forward-looking, okay, they start discounting for conditions 9 months into the future. Again, let's call it 6 to 9 months. In this case, it's going to make more sense if we say 6 to 9 months. Let me show you guys something really remarkable. Okay, let's go to the 2-year. Okay, here's the 2-year. Let's put the Fed funds rate on top of this, which we've done before, but I just want to show you guys how close the correlation is. So let's put that in. Okay, let's just put this in. New price scale here, but on the same chart. I mean, this is a look how it tracks. I'm going to just change this to a thick black line so we can really see it. So the thick black line is the Fed funds rate. Look how it tracks that 2-year. Amazing, isn't it? So we're talking about the inverted yield curve. We're talking about the need for that inverted yield curve to really come down at some stage, so that the actual so we're looking for that 2-year yield to come down, so that the inverted yield curve steepens again. And you can see that the 2s, well, if the 2 start adjusting, then the Fed funds rate will start adjusting. Is everybody okay with where we are right now? Because I'm going to just take us into a slightly different direction, which we have seen, I think, once or twice previously, but not recently. So if there's anybody with a problem understanding, you must let me know. But the idea here is the Fed funds rate clearly is highly correlated with the 2 years. Now, what we can do here is we can go through to, let's take off the Fed funds rate. And I want to take you guys to an instrument called ZQ. ZQ is a 30-day federal funds, but it's a future. So now we're looking at the federal funds rate on a 30-day basis, but priced on the futures market. And with the futures market, they've got different contracts. They've got the December contract, the January contract, the February contract, the March contract. And if I go all the way through to the July contract, let's bring that up. Okay, you can see that it's got 95.18. Okay, what does that mean? Well, if you take 100 minus 95.18, you come out with a Fed funds rate of 4.82%. And if you don't want to do the math, just right click on this and you can click percent. Okay, so there's obviously some rounding errors here. So they're saying that it's 4.86%, roughly 4.86%. That's kind of your terminal rate. So we're looking at a terminal rate of 4.86%. And in the last week's dot plots, in last week's Fed release, the dot plot said, well, we're looking at 5.1%, but the market's not buying that. The market's saying, well, 5.1% is too high. We are 4.86% here. Okay, 4.86%. Now, if you start looking, so this was the July contract. Let's go through to the August contract. Okay, we've got 4.75. So we had 4.86 in July. Well, that's your terminal rate according to the futures market, because in August it's starting to come down. We're down 11 basis points, right? From now, if you go all the way to December, okay, there's a point to this in a moment. Let's just go through to December. Okay, we've come down to 4.37%, so we've already got 50 basis points off. Already got 50 basis points. So the market, the futures market is telling us that there's going to be a 50 basis point cut in the second half of 2023. Now, whether that happens or not, I don't know, because the market's going to continually discount. It's going to continually change as more information becomes available. Remember, markets are efficient, but information is inefficient. So it really comes down to, as the information changes, so the market discounts efficiently the new information. So what we can see is that the markets are saying that the Fed funds future is going to start adjusting quite quickly in the second half of 2023. So what does that mean for us? So let's go back to the 2-year. Okay, is everybody kind of following that? I hope so. I know it's sort of esoteric type of concept, but it's very important. So here's the 2-year, and let's throw the Fed funds on top of that. So the Fed funds rate over the next year kind of goes to, we had 3.78 on this. It goes sort of to there, goes to about here, okay, until this point here, okay. Sorry, let me just, here we go. So it goes as such. Okay, it goes to about there, and then over the next 6 months, it goes like that. Okay, and that means that there is a good chance that this guy over here follows suit. Okay, and what does that mean? That means that that yield curve, okay, that means that the is that not wishful thinking? No, I actually think that it's probably more realistic than the market realizes. That's the whole point, in that the more that the market doesn't think that's going to happen, the more likely it is going to happen. Because if the market, if the Fed starts saying, well, we're going to start pivoting, well, the pivot's going to start discounting now. But if it's only going to discount in 6 months, okay, are we looking for the discount only in 6 months? And the financial markets are forward-looking 6 to 9 months. But if they're forward-looking 6 to 9 months, okay, well, okay, then the higher trough, higher peak becomes base case scenario, not best case scenario. It becomes base case scenario. Okay, so in other words, this peak, higher trough, higher peak, all of a sudden becomes very, very interesting indeed. Again, got to tag on subject to correction, because it depends very much on the data that comes up. Now, what data are we talking about? Okay, so let's go back to the calendar. Okay, let's go back to last week. Let me just go back to Thursday. All right, where's that data from last week? Let me just find it. Okay, so jobless claims starting to come up a little bit. Okay, because they were under 200, but this is the big data I was talking about. New York Empire State Manufacturing forecast to be +1 comes in at -11. The Philly Manufacturing forecast to be -7 comes in at -13. Okay, retail sales month on month. Its previous print 1.3, forecast to be 0.2, comes in at -0.6. Okay, so we're starting to get a real kind of contraction here in the economic data. Now, this is why it wouldn't be wishful thinking. Listen to this very carefully, Anna. Is that the Fed's job is basically done with regards to inflation. Okay, they don't have to. They don't have to do much more work, one would think, because we're moving into a recession. You know what kills inflation faster than contractionary monetary policy? A recession. Okay, so if you want to kill inflation, all right, and you're not in a recession, then you've got to go very aggressive with your monetary policy. Or once you reach that recession, okay, once you reach that recession, then inflation's naturally going to be hurt, okay, because you're in a recession environment. It means demand gets knocked right off its pedestal. So that's kind of the next phase of the economic cycle that we're in. Now, there is one outlier here, the biggest outlier of them all. The one thing that can potentially make it wishful thinking, you know what that is? That's the labor market. So if we go through to U3, so let's just bring up U3, which is this guy here. This is the one, this is the outlier. Okay. This is the outlier. And I think that's what why is the Fed still going so hard? It's because they actually want to get rid of the imbalance in the labor market. This labor market is where there is still inflation. There's that wage inflation that we saw in the non-farm payroll. Okay, so that's why the Fed's still being aggressive. I think they know that the recession's there. The recession's going to do all the hard work for them. The other thing that we can throw in here is, let's put it underneath, would be the participation rate. I'm going to put this underneath. Okay, it's actually starting to drop. The participation rate is starting to drop. That's bad news, because it means that your supply of labor is going down. Well, if your supply of labor is going down, it means that the demand supply is going to remain in balance. So the Fed tried very hard to get this participation rate up, and they just couldn't. So now I think they're just going an extra. I reckon they go another sort of 25. I'm sort of guessing here, but I reckon another 25 basis points. And then they see if the labor market responds. But if the labor market doesn't respond here, a lot of people lost from the labor market as a consequence of COVID. Yeah, that is true. So there might be something here that this might tick up. I'll tell you why it might tick up. Is because what happened with COVID and the influx of liquidity into the market is that a lot of people were able to retire because their wealth increased as the stock market increased. But the stock market's been pulverized over the last 12 months. So maybe they need to be pulled back into the market. But I'm not certain about that. That's very much sort of speculation. But the idea here is the Fed terrified here. Yeah, so they were allowed. They retired early because their 401ks had done really well. The idea here, though, is that this is very important mechanism in stagflationary economies. The really where the adjustment takes place is in the labour market, and we haven't seen that adjustment in the labour market. In fact, what we've seen is just going to bring this up again. Okay, just taking a look at price. So price, think of, let's call it inflation. Let's just call this economic activity. Okay, and then within that, we've got demand and we've got supply. Now, what typically happens is what the Fed is looking to do, okay, what the Fed's looking to do. So in stagflation, your supply curve moves up and it moves your price up. Okay. Your price moves up this way. Okay, that's inflation. That's inflation. And what the Fed wants to do is it wants to push this supply curve back down. So the way that it pushes supply curve back down is, well, if it becomes too expensive to pay employees, you lay off the employees that you can. Effectively, as your employees get laid off, wages necessarily come down. As wages necessarily come down, the cost of supply, because this labor is on the supply curve, theoretically comes down as well. Okay, so that's what they're trying to do. That's what they're trying to do. Whether we get there or not, Anna, that's the big deal. That's where we have to tag on that subject to correction. Okay, but the financial markets think it's probably what's in play. See that? The financial markets probably think that's what's in play. Yeah, you can see higher trough. Okay, Katie's asking for the NASDAQ. Let's take a look at NASDAQ here. All right. Here's your high. Here's your higher peak. Here's your next potential higher trough. Okay. HT. Okay. The question now: are we going to get a lower peak, or are we going to get a higher peak? If the market is starting to discount in a re-steepening of that, if it's starting to price in a re-steepening of the yield curve, well, then we could get that higher trough, higher peak. Okay, so it's pulling back KD to this higher trough. It's still, the daily chart here is rough. The daily chart here, unfortunately, what we need to do is we need to get some sort of clarification on the daily chart, and that would be from a movement from zone 3 into zone 2. So it's a difficult market because of the ambiguity between the weekly and the daily chart. But my reading of the situation, and again, I'm going to tag on that subject to correction, because I don't want to get stuck in forecasting. I don't want to get stuck in sort of predicting. But it seems to make sense to me that we need to re-steepen that yield curve. If we need to re-steepen that yield curve, then it makes sense to me that we get 50 basis points in the second half of next year. And everybody's saying that's impossible, that's impossible, that's impossible. That's the reason that it's possible is because everybody's saying it's impossible. If everybody was saying it was possible, it would paradoxically become impossible because everything would shift forward. So because the markets are forward looking. That's what's so brilliant about the financial markets. So the idea here, okay, is that this higher trough, I think, is something that, again, shouldn't surprise us. We've spoken about it before. Okay, now let's just take a look at oil. Yeah, and that's the last point. So her last point, employers are reluctant to let people go because they're hard to get. Yeah, let's leave that for the very last part of this webinar. I just want to take a look at oil and then we'll bring it in. Let's just take a look at US oil here. All right, so Katie, you can see oil's just looking lower peak, lower trough. You can see it's looking very, very weak, isn't it? It looks like it's falling back into that zone 3. In fact, Anna, just before we go into your point, let's just take a look at the PPI, CPI dynamic. Okay, so we've got just 2 more things and then we'll wrap up here. Okay, so we looked at this last week as well. Let's just throw in core CPI. I'm going to throw it in the same price, just using a same chart, just using a new scale. And you can see that in a stagflation environment, it's the PPI that tends to lead the CPI up and down. It led it up in the first oil crisis, it led it up in the second oil crisis, led it down in the first oil crisis, led it down in the second oil crisis, led it up in the invasion of Ukraine. Well, it looks like it's kind of leading it down now as well. So we just want to just keep an eye on this. So the fact that we've got that very weak looking oil chart, well, that possibly feeds into this type of dynamic. Now, the last thing to mention is, well, what about actually laying off employees? The truth of the matter is, and I think there is a certain stickiness to laying off employees, and that's because people are inherently, concerned about their employees. Okay, so you kind of got your business cycle like this. Okay, and what tends to happen is you kind of peak, you kind of trough over there. What happens is as you head over here, the purchasing managers, they start seeing that the economic activity is falling off. So what happens is they don't lay off employees. What they do is they start allocating them less hours. Okay, so they get less hours, and eventually it comes to the point where even the less hours is not sustainable, because although they're reluctant to lay them off, they have to control margins. Okay, so layoffs typically happen after the fact. Okay, and similarly, when it starts picking up, okay, they don't hire yet. They start allocating more hours to existing employees, but eventually it becomes clear that you need more employees, so you start hiring after the trough. You start firing after the peak, you start hiring after the trough. What am I saying here? I'm saying this. Okay, I'm saying unemployment is a lagging indicator. Okay, so at the moment, I would have expected that I would have thought that we would have hit this point already by now, but we haven't. Okay, and I think that's just a testament to people holding on to good employees because they're very hard to find. But eventually, margins went over. Okay, so yeah, there is a reluctance. The reluctance is in effect why unemployment is the lagging indicator, because there's a reluctance to get rid of quality employees. At some stage, margins went over. So we're going to have to watch how that unfolds. That's sort of the theory behind it. Whether it unfolds in that sort of manner or not, I don't know. But that's the theory. And then the other important theory is that, okay, is that there has to be some sort of adjustment. There has to be some sort of adjustment in the market to bring inflation back under control. Inflation's starting to come under control. Okay, now it's under control because of the production side of things. Okay, I think to really get this down like this, I think the Fed is going to try very, very hard to just bring that unemployment level up. Okay, and I think that's why they're still being aggressive. Otherwise, it doesn't make any real sense. But because they're still being overly aggressive so late in the cycle, I think they're going to have to pivot. And when they pivot, they're going to have to pivot very quickly. And that's why we have 50 basis points coming off in the latter six months of next year. One last thing before we sign off. Remember, markets are efficient, information is inefficient. This can change. Well, by the way, I know I keep saying last thing. This really is the last thing. When you take a look at the Fed funds futures, before Wednesday, they were actually at 4.95%. Your terminal rate was at 4.95, but let's call it 4.92, I think. Now it's at 4.86, and that's after the terminal rate was increased by the Fed. Now, something doesn't sound right there. The Fed says one thing and the market reacts another way, and it reacts the other way after the economic data comes through. So it's a very difficult market, but I think we keep our eye on the economic data and see if it continues to show signs of contraction. All right, I think we've got to leave there. We've done a really long session this morning. Are there any questions? If there's any questions, type those in. But we did a really long session today. All right, let's wrap up here, guys, and then we shall talk again tomorrow morning. Have a good day and a good evening ahead, and we shall chat on the morrow. Cheers, guys.